today is being recorded, and so we will have some people who are watching online. And so there are resources that I want to mention to you. And first are resources at the State Board of Admissions, alsbaum.org/CCS. That stands for Church Compensation Services. And there you can find the financial issues book, which is not in your packet. There you can find a minister estimate of tax. We're going to talk about that in a little while. Also, Guidestone is a great resource, and you can go to guidestone.org/compensation planning. Now, for the minister tax guide, some of you may be used to getting the tax guide, and it's the white booklet called Minister Tax Guide that we get every year from Guidestone. And this year it's available online, and you have to log into your account to go there. It's not just, used to it was just you go to Guidestone and do a search and search for Minister Tax Guide. But this year's guide, you log into your account first and then click on Statements, and then click on the Minister Tax Guide. And that's where it is. We're going to talk about some of the things that are in the guide, some of the basic principles. Today we're going to talk about principles and how to save. We're not really going to talk about forms. We're really not going to talk about forms hardly at all. I might mention a form, might talk a little bit about a form. If you've got a question about a form, we'll be glad to talk about it. But I'm not going to mention that as much as how do we save? How do we save on our taxes? So these are some of the resources. I've also listed my phone number there, and those of you who are here, you've got my card there. But and this one is that one is my cell phone. I mentioned I'm retired. I've been retired for 6 years. I work part-time. I work out of my home mostly, but I'm not here in the office a whole lot. But if you ring the office number, it rings my cell phone. So I'm pretty easy to get in touch with. So those are some resources that we need to be aware of, and all of us need to be aware of how to get to the Minister Tax Guide this year. It's a little bit different than what it's been in the past. All right, take out the sheet that you see that says 25, 26 tax changes. We're going to talk through those and look at kind of what's new this year. So first of all, the big thing, the big news is that the OBBB, the One Big Beautiful Bill, it made permanent the tax changes that happened in 2017, the 2017 Tax Cuts and Jobs Act. And so those were set to expire. If Congress had done nothing, those would have expired, and then our systems would have gone back to the way we used to do it back in 2017 and before. And if you'll remember, we had personal exemptions. You had your standard deduction, but you also had personal exemptions. You had a more complicated tax situation back then before 2018. And so that bill, the bill this past year, 2025, made those changes permanent. And that's the big news. So it made all of that permanent, including, and this is one thing that Hammer talks about in the tax guide, including the fact that employee unrelated business expenses that are not, employee unreimbursed business expenses can't be written off on your taxes. Still, that's a permanent thing. You won't be able to write off any business expenses related to your church at all. And that's been the case since 2018. And still there's a lot of ministers who want to try to write that off, and you won't be able to. But that's permanent. The fact that moving expenses, if your church reimburses you for a move, that money is taxable. and that changed with 2018, and then that was made permanent with the 2025 bill. So that's the really big news, is that those things were made permanent. Now, on the good side, it made permanent the fact that our taxes are a little bit simpler. We have the greatly doubled, and then even more so now, standard deduction, which is so much bigger, and that makes our taxes simpler in that a lot of us don't itemize or can't itemize. Now, we in Alabama, we need to still go through our itemized things like charitable contributions and property taxes and your medical and things of that nature. Because of Alabama tax, you can still itemize. Most of you will still be able to itemize on your Alabama tax. So we still have to figure that. We still have to look at it. If you're using some kind of software, you'll enter it, and the software will say, you don't have enough to meet the standard deduction, so do you want to take the standard deduction for your federal? But then when you look at your Alabama tax, it will itemize that for you. Okay, so it made those things permanent, and that's the big news. That's the largest news of all. Now, standard deduction went from $15,000 to $15,750 for singles, and $30,000 to $31,500 for married filing jointly in 2025. And in 2026, the standard deduction for a married couple is $32,000. I'm going to close this door. Standard deduction for 26 is $32,000. So that standard deduction has gone up quite a bit, and that helps reduce our tax burden. Now, so here's some things that changed. The child tax credit was increased. It was increased from $2,000 to $2,200. You'll remember before 2018, the child tax credit was $1,000. And it stayed at $1,000 for years and years, but now it went up to $2,000, and then now it's $2,200, and also it will be indexed for future years. It will continue to go up as inflation goes up. Also, another thing about the child tax credit is more of it is refundable. $1,700 of it is refundable. Now, what that means, you have a credit. And a credit is money reducing your actual tax bill, not just reducing your income, but reducing your actual tax bill. And if you could work your tax bill for federal tax down to zero, and you still have a credit, then if it's a refundable credit, you'd still get money back. If it's a non-refundable credit, you work your tax bill down to zero, and just too bad. You can't reduce it anymore. So that's a refundable thing. So for a child tax credit, it's for children age 17 and younger. I mean, younger than 17. So that I've never understood that, because why is it at 17 and younger? I don't know, but it's younger than 17. Okay, I remember when my youngest daughter hit that point, and I'm like, oh boy, we lost a tax deduction there. All right, state and local sales tax deduction and property taxes, those kinds of things, local, went from $10,000 to $40,000 that you could deduct. And then the estate, here's what you all came for today. The estate and gift tax went from $13.99 million to $15 million. So I know you can all breathe a sigh of relief on that one. But then there is a senior bonus deduction. So if you're 65 or older, you get a bonus deduction. Now, we've always gotten a bonus deduction. So you had the standard deduction and another deduction for being over 65. And in the past, that was what, $1,200, $1,300? Now it is $6,000. $6,000. And if you're married, it's $12,000. It's per person over 65. Now, if you remember, Trump said we're eliminating tax on your Social Security benefits. Well, sort of. And this is what they did. They did not eliminate the tax on Social Security benefits, but they gave you a much larger deduction. And so the way this works out is for people in lower incomes and maybe into middle incomes, it does reduce and basically eliminates any tax on Social Security benefits. But if a married couple makes $150,000 or more, they don't get that at all. They don't get it at all. But or a single makes $75,000 or more, they don't get it at all. But it's a larger deduction for seniors to deal with that promise of we're going to eliminate tax on Social Security benefits. So that's what they did. All right, the next thing is that there are Trump accounts for child savings. And you've seen this in the news these last few days. And during 2026, the mechanism to do that is going to be established. But if you have a child born in 2025, 26, or 27, they can get, is it through 27, I think, or I think through 28. If you have a child born, then you can get $1,000 from the government, and there's a form that you fill out in order to do that. And they will set up an account. It will be basically an account that's going to be kind of like an S&P 500 type account. It's supposed to be investing, not savings. It's supposed to be for your future, and the child can't access it, I think, until they're 18, and there's only limited ways to access it. So it's for, what they've talked about is for generational wealth. Now, parents can put in $5,000 a year. Others can put in money, like grandparents, and even your employer could put money into your Trump account. Now, I don't know how many employers are going to do that, but they could. So that's going to happen. And even if you have a child that, wasn't born during those years, you'll still be able to set up such an account. I've read and heard some reports on this, and some have likened it to a 529 college savings account. And but it's just different. This one is for, say, when you turn 18, when you want to buy a house, for future investing and savings, things like that. The 529 is for education expenses, college. It could be trade school. It could be things like that. And the 529 account, you will spend it tax-free. So there's a little bit of an advantage to the 529 account if you think that your child is going to go to college or trade school or something like that. But if you've got a child born 25 through 28, take the money from the free money. So that's a good deal. All right. Car loan interest deduction. For starting this year or last year, there is a auto loan interest deduction of up to $10,000, but it has caveats to it. You have to buy a brand new car. It can't be a used car. And it has to be American made. And what they mean by American made is that the final assembly point is in the United States. So that could be, Hondas and Toyotas are made here in Alabama. And there's one model of Mercedes. Is it just one still? Or is it more than one model? There's a model of Mercedes built in Alabama. There's a few other cars built in various states in the country. And I think for some makes, you're going to have to find out. For example, there's a BMW that's built in South Carolina, but I think it's only one model, and to my knowledge, all the rest of the BMWs are made in Germany. So on some of these things, like your average Honda or Toyota, you're probably going to find that those are built here. But if you look at a different kind of car, you might have to look it up and see. And what I understand is it has to do with the final assembly point is what is defined as being made in America. So has to be a brand new car, can't be used, has to be made in America to get that deduction. All right, next, there's a tax break on tip income and overtime pay. And so tax break on tip income is up to $25,000, and they will be able to deduct their tip income. And it's only for occupations that are known to have tip income. The usual. I had this question when this first came up. Well, can we give our staff a bonus, and can we call that a tip? And I said, no, I don't think that's going to work. And so it is for those occupations where tips are normal. Then on overtime pay deduction of up to $12,500. Now, this one, churches and other employers are encouraged, if you've got overtime pay of some of your workers, you're encouraged to put that overtime pay in box 14 so that the worker will know how much is overtime pay. It just is helpful. There is no actual legal requirement to have to do that, but it's helpful, and otherwise that person might not be able to figure out how much tip income they had, overtime pay that they had. But what they will be able to deduct is not the full overtime pay, it's the extra halftime. So, with overtime pay, you're getting time and a half, and it's not the time and a half, it's the half. It's the halftime that they'll be able to deduct. All right. EV tax credits are expiring and have expired, both for electric vehicles and for things that you might do to your home, like solar panels, things of that nature. The tax credits on those have expired. All right, charitable deduction. Beginning in 26, everybody, even those who are not able to itemize, they will be able to deduct $1,000 each. So if it's husband and wife, they'll be able to deduct $2,000 on their taxes, even if they can't itemize. And by the way, that's made permanent also. Perhaps that might, when you think about things that are changed for the church, that might make somewhat of a difference. Maybe it'll encourage giving. I think people give because, of what God's Word says to us, not so much of tax break, but maybe that might be a little bit of an incentive. All right, 1099s. The threshold for a 1099 has gone from $600 to $2,000, and that threshold will be indexed for inflation in future years, but it's gone up to $2,000. But that does not have to do with 2025. So your ministry assistants and financial secretaries, people like that have been working on 1099s in the last few days, it's still $600 for the ones they're working on related to 2025. And so it'll only be 2026 where that threshold actually goes up to $2,000. Okay, and so bottom line for the church. Bottom line for the church is not much has changed. If this had not been done, then things would have changed a good bit. We would have had to do the W-4s in a different manner. That's our federal withholding. We would have had to do those in a different way, and we would have had to think about some of those kinds of things. The other thing that's different for the church is this tax deduction for $1,000 of giving. That might be a difference. And then the other things, if you do have, at your church, if you do have people who are receiving overtime pay, you are supposed to put that in box 14. It's not a requirement legally, but it is suggested by the IRS so that they can deduct that. Okay, what questions do you have about tax changes for 25, 26? What questions do you have? Anything? Okay. Now, there are some other changes that are for higher incomes that I did not put on this sheet, but I just wanted to put the basic things here. For example, if you're in a higher income and you want to do catch-up, if we're over 50, we can do catch-up contributions into our retirement. And if you're a higher income, doing those catch-up contributions, you'll be required to put that into Roth versions of your retirement. So in other words, what they're saying is you got to pay the taxes on it now. So that's for higher incomes. There's a few other things for higher income, but I just kind of pulled out the things that I felt like were the most basic things for most of us. All right? Okay, so that's the tax changes that have occurred. Let's move on, and let's take out your compensation planning guide, and also you've got a close that one, and do this one. You've got a little handout that gives you the PowerPoint slides for this, what we're doing today. And so take that out and the compensation planning guide. All right, everybody got that? All right, so first of all, I've given you on the sheet, given you resources, and those are listed there. Some State Board of Admissions, Guidestone, the follow us on Facebook and stuff like that so that you'll get announcements about what's going on and blogs and things like that. All right, I've been doing some reading, and some of what I've been reading is not so good. So I read an article that said that a retirement gift, now this is not in your notes. I just wanted to say this. I've been reading an article that said that retirement gifts given to a pastor are not taxable. Not taxable. Well, that goes back to a IRS ruling from 1955. Since then, in the 1980s, the IRS came up with it's like Code 102, I think it is. I don't try to keep up with all those code things, but basically says that any money from employer to employee is taxable, unless the IRS says otherwise in a specific thing that makes it not taxable. For example, if you had an HRA, a health reimbursement, that could be done, if it's done correctly, that could be done in a way that's not taxable. If you've got your business expenses reimbursed to you, that's not taxable because the IRS says it's not. It's got to be done accountably. But so basically, any money that comes from employer to employee is taxable. And every year I get the question, we're doing a Christmas love offering, or we're doing a staff appreciation love offering or bonus or something like that. Is there any way we can make that tax-free? And basically the answer is no, you can't. So that article was not a good article. I saw it recently, and yet it's relying on something that goes way back to 1955. There's articles that try to get you to basically declare yourself as self-employed. and you're not. Not if you're serving a church. If you're serving a church as pastor, associate pastor, some other minister, ordained minister on staff, you are not self-employed. You're self-employed for your Social Security, but you are an employee. You do get a W-2, and you can't declare yourself as being self-employed. And so that's some articles I've read try to do that. The reason they do that, so that you can write off business expenses. But we are employees. We're employees, and so therefore we cannot write off business expenses related to our church. Articles about opting out, trying to advocate to opt out of Social Security. Guidestone has an article that's pretty strong on we should not opt out. Now, I know that many of our ministers have, but we should not opt out. And they have a pretty strong article, and they even said that we don't qualify. That was their statement. But like I said, I realize that there's some. But to opt out of Social Security, you've got to sign a statement saying you feel conscientious objection to receiving government insurance. And it's not that you object to paying it, but you object to receiving it. So that's the statement that you have to sign. There is likely to be an opportunity for those who have opted out, and if they feel like, hey, I want to opt back in, there is likely to be an opportunity to do that. That's been a discussion in Congress to allow ministers to opt back in, those who've opted out. If they find that they opted out, not knowing really what that all meant, or just their desire to get back into it, that may come about, possibly this year. But Guidestone has a pretty strong article about not opting out of Social Security, and so you see on the, everything's on the internet, and you see articles out there pushing you to declare yourself as being totally self-employed when you're not. Another thing that some of these articles have talked about is home office. Well, that's been for decades. The IRS has been skeptical about ministers having a home office because you've already written off your entire house. So you're going to write off your house plus the space that's the office. And they used to say when you could do it, they used to say that you had to exclude part of your house from the housing allowance in order that same part that you're wanting to write off as a home office. And that's the way they used to say it. But this is the most interesting thing time-wise I've ever seen. They have declared that anybody, and this is in IRS terminology, anybody who receives a W-2 cannot write off home office, period. Anybody that gets a W-2, you can't do it. When they did that? During COVID. They did that during COVID when everybody was working from home, and they said if you get a W-2, you cannot write off home office. So that's no longer a point at all, and yet I've seen an article about that not too long ago advocating for that when you just absolutely cannot do it. So be careful. Be careful about what you read. Be careful of what's on the internet. Be careful about those kinds of things. And I just wanted to mention, and you might want to jot these down, some great authors, if you see one of these authors, it's a good article, it's going to be trustworthy, that it's going to be good information. And so Richard Hammer, he's the one that writes our tax guide every year. And he also writes, some of us in church business administration know that he also writes a 700-page minister, clergy and tax and church tax guide every year. So he is the number one author in terms of ministers and church and tax in the United States today. Now, he has retired, and Elaine Somerville is helping him in these duties in the tax guide. In fact, if you get a copy of the tax guide online, you'll see that Elaine's name is also mentioned there as being one to be involved in the editing of the tax guide for this year. Frank and Elaine Somerville. Frank is a tax attorney dealing with nonprofits and churches. Elaine is a CPA dealing with nonprofits and churches, and they are nationally known in church circles. Everything they do is well done. Michael Batts is another CPA, well known in church circles on a national level. Of course, Guidestone is going to have great articles. And also, get on the mailing list, in terms of their email stuff from ECFA, Evangelical Council on Financial Accountability. They send out some free articles. They do have some webinars that you'd have to pay for, but they send out some free articles fairly often that are always well done, always good information. So have a good reading list. Don't rely on some of the things that you see out there. Okay, one more form. Take out the form, Minister Estimate of Tax, 2026 Minister Estimate of Tax. It's in your guide, in your packet there. And so the W-4 form, that's for federal withholding, that form does not work well for us. And it just doesn't work well. The W-4 form is basically your name and address and social security number and stuff, and your filing status. That's step one. Are you filing married, filing jointly, things like that. Step two is, do you have other sources of income, like one of you's working two jobs, or both husband and wife are both working, things like that. That's step two. And if that's true, you check this little box, which makes it deduct less. Then, in other words, you're going to do more withholding from your paycheck. Step three is, do you have children who are under age 17? Will you be getting the child tax credit? Step four is, do you want more withheld? And for ministers, yes, we do. We want more withheld, and I'll show you how to do that in a minute. And then step five is to date and sign your form. But that doesn't work well for ministers, and so I prepared a form that is just one page. It's called 26 Minister Estimate of Tax, and I wanted it to fit on one page. It's an estimate. I did two things wrong that I'm going to tell you about, so you'll know. So it's not perfect, but it will give you a reasonable estimate. So what you do is you take your income, but not housing, and then you add other taxable income to it, and then you add to that taxable income in the home, other taxable income to the home, like a second job or spouse working or something like that. You add that other income, and so you come up with total taxable income in the home. Then you subtract the standard deduction. So for a married couple, that's $32,000 this year for 26. And let's just take an example. Let's say that a pastor makes $50,000, and in addition to the $50,000, he wants $20,000 as housing allowance. So he's a full-time pastor. He makes $70,000, and so that's his income. So you take his taxable income without the housing allowance, so 50, minus the standard deduction. Let's say he's married, minus the standard deduction of 32, and you come up with 18,000 taxable income that he's going to owe. Then we're going to multiply that by 12%. 12%. Now, I happen to know that for $18,000, you're still in the 10% bracket. So I'm gonna make it easy on my head and multiply 10% in my head and come up with $1,800 is what he's going to owe. And so what you'll see, my first mistake, I skipped the 10% bracket. I went on to the 12% bracket, and I I just figured those two numbers are very close together. It will estimate slightly high. But I didn't want to complicate the form by making you multiply by each tax bracket. And so I used the 12% tax bracket. Then, so we're going to come up with a federal income tax that they owe of $1,800. Then you come down to the Social Security tax, SE tax, and that is the exact figure. So it is times 0.9235%, then times 0.153%, and that 15.3%, and then that's going to give you your SE tax that you owe. And so for a $70,000 income, that's going to be about $10,500. I just multiply that by 15%. It's actually going to turn out to be a little bit less than that, but $70,000 turns out to be $10,500 in SE tax. That's a little high. So 10,000. Let's just round it down to 10,000. That's pretty close. 10,000 plus 1,800. So he's going to owe $11,800 in tax for the year. That's his grand total tax. Then you subtract for the family. Then you subtract any federal income tax by any other jobs that's already being withheld. And then you come up with how much does the minister owe in taxes. And so let's take the 10,000, let's just say $12,000 divided by either by 4, and you get $3,000 per quarter, or divide that by the number of paychecks that you have, and the church can withhold that as federal income tax. And they can do that, and they can send it in as federal income tax. They cannot do FICA on an ordained minister. So you can't do that, but this is a way that you can get your federal income tax taken care of by doing withholding if you'd like to. And personally, I like doing it that way. But this estimate is going to get you close. It's going to get you reasonably close. We're talking about horseshoes here. We're talking about close. And it is going to estimate just a slightly bit high. It will work for an income of somewhere around even up to your income plus your housing allowance. Now I'm talking about family income. That'll work to about $140,000, $150,000 in total family income. So beyond that, you need to account for the 22% bracket. And so money beyond that would be in the 22% bracket, depending on what your housing allowance is and things like that. But this is going to get you reasonably close. Do y'all have questions about this form? And what we just went through is also going to tell you kind of how your taxes are computed this year. It's very similar to that process. So that'll, when you compute your taxes, this, after going over this form, that will be a more familiar process to you. Okay, any questions about that one? All right, let's keep on going. So important tax changes, as we said earlier, the ability to write off business expenses related to your church, you don't have that ability anymore, and that's now been made permanent by the new tax bill of 2025. So that, and also the moving expenses being taxable, that has been made permanent as well. All right, in the 2026 tax guide, I have put in your handout here some things that are from the tax guide, things that I've kind of pulled out there, and things that you'll want to know. And if you download the tax guide, you can sort of go to those pages and highlight some of these key concepts that are really, really important for us. And so the first key concept is found that we have a dual tax status. And this is in the handout. You've got a handout that it's your slides plus some notes lines. And so the very first key concept here is dual tax status. You as a minister, as an ordained minister, you have a dual tax status. You are a employee, and you're an employee for federal purposes. You're self-employed for Social Security purposes. You have a dual tax status. That's one thing that all of us need to understand, because it makes a big difference in our tax situation. And of course, we have to do the SE tax. So what does this mean? It means that we have the opportunity for housing allowance, but on the other hand, they can't do FICA on us. And we have to do our own self-employment tax, which is our Social Security taxes. And so to be a minister for federal purposes, for income tax purposes, you have to be ordained and you have to do the functions of ministry, leading worship, leading the ordinances, leading the organization, and considered to be a religious leader by your church. Now, you could also be licensed, not ordained, and but the IRS says if you're licensed but not ordained, you must be able to do essentially everything the ordained minister can do. Does that make sense? And I've seen a few youth ministers who were licensed, not ordained, but they were preaching and they were baptizing the youth that they led to to Christ, and they were doing those things, and some of them really did qualify. Dual tax status. In your notes, I put the page number in the tax guide and where you can find that, even the column where you can find that. Now, there are, in the tax guide, I have skipped forward to an important warning, but of course you don't have the guide in front of you, so you don't have to move pages there, but it's in your notes pages here, is that many ministers continue to report their income as being totally self-employed. And a perceived advantage is the ability to deduct business expenses on Schedule C. However, if audited, the IRS is going to change those, make you an employee. You won't be able to deduct those business expenses, and you will owe additional taxes and penalties. So Social Security taxes, do ministers pay Social Security taxes? Yes, they do. And how do they pay their Social Security taxes? It's the SE tax, self-employment tax. And this is even talked about in, I've listed it here. This is IRS code 3121B8A. And that's where it says that we as ministers do have to pay our own Social Security taxes, and the church cannot do FICA on us. I'm asked that sometimes because, especially in this day and age, we've got a lot of ministers who want the church to treat them as a regular employee and take out the FICA, when they're ordained, like I'm talking about like a pastor or something like that. Now, you do have regular employees at your church who are not ordained, and you would take out FICA, but on an ordained minister serving a church, you would not, and here's the IRS code that tells you about that. So we got to do our own, and you can do it by withholding extra federal income tax. Okay, now there are some ministers who are truly self-employed, like evangelists, like authors. Some authors are truly self-employed. And then all of us have some self-employment income. Now, this is what complicates things. We do have some self-employment income, and that's things like weddings and funerals and speaking engagements, or if we did a revival for some other church or things like that. That is self-employment income, and you can write off the business expenses related to that self-employment income. And so that's kind of confusing. You've got W-2 income and you've got self-employment income at the same time. And so you can write off business expenses related to those activities. All right, everybody on board? Okay. Also, ministers are better off as employees. And so if you're self-employed, you can't receive employer-provided benefits. If you're self-employed, you have a lower risk of audit. And certain benefits will be tax-free. And it avoids the risk of being reclassified as an employee of the church, and your taxes changed and you ended up owing more tax and penalties. So ministers are better off as employees. I mentioned this a little earlier. Should we opt out of Social Security? And this wording that's in your tax guide is from Richard Hammer, and he says that most ministers do not qualify, and he talks about what is involved if you look at that to see if you qualify, and it's for conscientiously objecting to receiving government insurance. If you do opt out, you'll want to keep that form forever so that you have proof of that, just in case you should ever get questioned by the IRS about that. And like I said earlier, there may be an opportunity possibly this year in order to opt back into Social Security for those ministers who might want to. Okay, how do ministers pay their federal income tax and state income tax, and how do they pay those things? They can do it one of two ways. We are not required to do withholding. The church is not required. And so you can do your own quarterly taxes, and you can do it that way, or you can do voluntary withholding. And so if you want to do voluntary withholding, do some kind of process like we talked about just then to figure out how much the withholding needs to be, and then divide that by the number of paychecks and have the church withhold that amount. If you want to do your own quarterly taxes, then you take that grand total tax that you're going to owe, and you divide that by 4 and send it in each quarter. And to meet the deadlines, you'll use Form 1040-ES, which is a little bitty form. It just basically says how much do you think you estimate that you owe, and send it in. I mean, it's just almost that simple. And you compute the estimated taxes, and you meet the deadlines, which are April 15th, June 15th, September 15th, and then January 15th of the next year. Those are weird, kind of the way that they do those dates. They're spread out a little differently than exactly every 3 months. Some other notes from the tax guide. Page 15, income, and we're going to talk about income in a few minutes, but on page 15 of the tax guide, there is a list of those things which are taxable income. And these are things that are the minister's responsibility to report. Even if the church does not report it, you are responsible to report it. Remember to track itemized deductions for Alabama income tax, even though many of us cannot do itemized deductions for federal tax. And also, I've been talking about unreimbursed business expense. You cannot write that off on your federal income tax, but do track it if you have some business expense that's not reimbursed, because you can write it off before you calculate your SE tax, and you can write it off on your Alabama income tax. So try to have all your expenses reimbursed to you, and that's the best way to do it. But if you do have employee unreimbursed business expenses, you can write it off on those two forms, but not on your main form. Okay, have a quiz for you. We're going to think about what kinds of money are better, what kind of income is better tax-wise, what kind of deductions and things like that are better tax-wise. So out of these four things, we're going to do a quiz here. Take these four things: child tax credit, dependent care tax credit, the IRS Form 8880, credit for retirement savings, energy credits, and all the deductions that we've talked about. Which is better, a credit or a deduction? Deduction or a credit? Okay? Here's the answer. A deduction reduces your income subject to tax. A credit is actually money subtracted from your actual tax bill. From your actual tax bill. So let's take our example. The minister, his taxable income was $50,000, and he had a standard deduction of being married, had a $32,000 standard deduction. That $32,000 standard deduction doesn't save him $32,000 on his taxes. It saves him 12%, well, in this case, 10% of $32,000. So $3,200 is what it actually saved him. But if he had a child tax credit of $2,000, or $2,200, it is today, that is actually subtracted from the tax bill. So a little while ago, when we calculated that minister who had a $50,000 income plus $20,000 housing allowance, we came up with, for federal, he only owed $1,800. But what if they have a child under age 17? Well, now he doesn't owe anything because it's the child tax credit is actually subtracted from the tax that you owe. And in fact, $1,800 is less than $2,200, so he would actually still get some money back on his taxes. So a credit is better than a deduction. And we're going to talk about some different things like that. Which is better? Which is better tax-wise? Now, out of these, the child tax credit is probably the best tax credit because so much of it is refundable. Okay, here's another quiz. Which of these is the greatest tax savings? Housing allowance, retirement savings, deductions, or credits? Deductions, rank these in order 1 through 4, 1 being the greatest savings of all. Which one saves you the most on your taxes out of these 4 things? Housing allowance, retirement savings, deductions, or credits? Anybody want us to take a stab at it? What's number 1? Housing. Okay, and that's what everybody thinks, housing. But it's actually not, because housing, it saves us on our federal, it saves us on our state, but we still have to pay Social Security tax on housing as well as on our salary. So we're paying 15.3% on that salary and housing allowance. All right, what about, we've kind of said it, credit. Credit would be number 1 in this list. And you might want to just write a number 1 beside it. Credit would be a number 1 because it's actual savings off of your tax bill. What do you think's number 2? Number 2 would actually be retirement savings. You can put your money in tax deferred, and you don't have to pay any taxes on it now. Now, the norm is that we will pay taxes on it when we take it out someday. But we as ordained ministers will be able to take out some of that or even all of that money as a tax-free housing allowance.
Oh, if you use it for housing, okay.
Yeah, if we have our money with Guidestone. Because Guidestone has the authority from the IRS and other denominational providers of retirement. They have the authority from the IRS to grant you housing allowance. So you can have a housing allowance in your retirement years. So number 2 on this list would be housing allowance. Retirement savings. Number 3 would be housing allowance, because that is going to save you on your federal. It just doesn't save you on your SE tax. And then finally, a deduction would save you on your federal income tax and state income tax, but it's a percentage deduction. It's not actually saving you off of your tax bill, just off the income. Okay, does that all make sense? So I would rank it number 1, credits, number 2, retirement savings, number 3, housing allowance, and number 4, deductions. Okay, kind of interesting. And most of our people in our congregation, they think the housing allowance is the best tax break since taxes have ever been invented in, the dinosaur age, They just think that's the best thing, and it's not. It's good, but it's not because it's not perfect, because you still have to pay the SC tax on it. Okay. How to save on tax. So, how to save on taxes. Guidestone Compensation Planning Guide, and we're going to look at that in just a moment. It tells us to do an accountable reimbursement plan for our business expenses. It tells us to have benefits, and it tells us to do the housing allowance the best way that we possibly can, and maximize that, and do those things in order to save on our taxes. So we're going to go through that. In fact, let's go through the compensation planning guide right now. In fact, I'm going to step over here and get one. And this has some extra information in it that it didn't used to have, and I think this is just wonderful the way that they've put this extra information in it. So, page 2, when you very first open it up, we have that, first of all, doing compensation well is biblical, it follows God's word. Second, there are dangers of the lump sum or package approach, especially these days, especially in our tax situation today, there's dangers there, because if the way we used to do it was, here's X number of dollars, you divide it up any way you want to. Well, you can't do that. If you do that, it's basically all taxable. You can ask for housing allowance, and you can ask to put money into your retirement, because those can come from, those can be done, but the rest of it can't be done, and you're going to end up with that being taxable. And so you'll notice this little globe here that's there. Download the package versus salary handout from Guidestone. Very good piece that talks about the dangers of the package or lump sum. Then number 3, you've got the eligibility requirements for a minister for tax purposes, and we've talked about those. And in that second paragraph, it says that these ministers have a dual tax status. They are employees for federal purposes. They're self-employed for Social Security purposes. So that's very basic, very good information to know. Everybody in this room needs to understand that I have a dual tax status. So we want to create a plan, and in this planning guide, the very first step is determine the needs, and it's basically a worksheet. We're going to kind of thumb through this relatively quickly and stop at a few points. So determine the needs. Second, we should establish written compensation plan policies for our church. And you need to have these things written down. I find that there are churches where somebody, usually a pastor, goes in and says, y'all are not doing this right. Let's do it right, and let's set it up right. And so they set it up right, doing what's in this guide, and then they didn't write it down. They didn't make it a part of their policies. And so when that pastor leaves, the next time around, they go right back to the package approach. So do put these things in writing. and it should have in writing that you have ministry-related expenses that are reimbursed, that you have employee benefits, and then how you do personal income, which includes housing allowance. And then you could have other personnel policies like vacation and sick time and sabbatical leave and things of that nature. So that's step 2, put it in writing. Step 3, provide for ministry-related business expenses. And so at the top of this page gives you the things, the bullet items there are those things that you can do and reimburse. So your vehicle miles, that can be reimbursed when it's used for business purposes. You can do education and reimbursements for education, for meetings, workshops, conferences, for books, periodicals, publications used in ministry preparation, for continuing education, and for provisions for ministry-related hospitality. And that is that you can take a prospective family to lunch and get that lunch reimbursed. That has a business purpose to it. You can tell them all about the church, find out what their prayer needs are, and so forth, and that can be reimbursed. Now, so those are things you can be reimbursed for, but and so you need an accountable reimbursement plan to do it. And then notice that it says here the impact of the Tax Cuts and Jobs Act 2017, and then of course the 2025 bill made that permanent. I'm here on page 7. Is that made all of that permanent, and that you cannot, as an employee, you cannot write off business expenses related to your employment. Now, the requirements for the accountable reimbursement are that you have this done in writing, that you account for it, and on your mileage you show date, place, purpose, and number of miles, that you have a business purpose to everything. It's done every 60 days. You turn in a report at least every 60 days. Most people do it every 30 days. You can use the IRS standard mileage rate, which, y'all know what the mileage rate is for 2026? 72.5, yeah, 72.5. And unused, the bottom 2 bullets, unused money should not be given as a bonus. And then all reimbursements must, notice that word must, come from employer funds, not by reducing the salary. And then on page 8, bottom of the page, you have a warning triangle there, and it says, according to IRS code section, and it gives the IRS code section, business expenses must come from the employer funds, not by reducing salary or allowing the minister or employee to rearrange his compensation. So it's got to be a church budget item. Okay? So the old package approach just isn't going to work for that, because it can't come from the employee. It's got to be a church budget to do that. Everybody on board? Okay, on the next page, you've got how to set up such a plan, and the bottom of that next page, you've got a sample form. We use a spreadsheet, Excel spreadsheet, so ours is pretty easy to do. We are headed towards, and I know many churches already have it, where it's done on an app, and you send that in from an app, and that makes it a whole lot easier to account for your business expenses. All right, while we're talking about business expenses, let's talk about a couple of things. And let's see, I've already done those. Let's talk about a couple of things of that. Commuting, your trip from home to church is not business, and it's your commute. You don't count it as business. And I used to think that if I'm going back to the church for another meeting, like at night, I could count that. But no, it's still your commute. And so it's no matter how far it is, no matter how many times that you do that commute. I know some bivocational pastors who live like 50, 75, or even more miles from the church. And the church could reimburse them for that mileage, but it's taxable income. It has to be taxable income. That's their commute. My commute is 172 miles, one way, coming from Huntsville. So anyway, commuting is not something that you can write off as a business expense. Okay, that's first. But also, this is something that's interesting, and this is not in the compensation planning guide, but it is something that is helpful. So we first of all think about mileage, and where can I write off mileage from? Obviously, I can write off mileage when I leave from the church, but there's a thing in the IRS that says you can have a temporary work location. And so we have done, and this is from publication 463, IRS publication 463. And so this is a chart that's actually in that publication, that IRS publication, and we just put some church labels on it. And so from your church, the black line is business related. So I can go to the hospital, that's business related. I can go visit a person in their home, that's business related. I can do those things that's business related. The dotted line is my commute, home to church. I can't count those miles. But can I ever count from home? Yes, if it is a temporary work location. And so I can count, let's say that I'm going to buy supplies for the church and I go to Walmart. I can count from home to Walmart to the church, or home to Walmart and back, and I'm going to take the supplies to the church tomorrow. You know, that sort of thing. So I can count mileage even from home if it has a business purpose and if that is a temporary work location. Now, if it's a permanent work location, it would be my commute, and I can't count it. Like, for example, this guy's got 2 jobs. So his commute from home to that second job is that's not business miles either, and he can't count it. So if you go to publication 463, you can find this actual chart that gives you an idea of what miles you can count and what miles you cannot count as a temporary work location. Okay, this next question that I get is, well, what about meals? What about meals? And so the IRS divides this into transportation versus travel. Transportation is local, it's today, and I can't count meals. So let's say that I drove to Birmingham to visit a hospital and back, and I had lunch while I was on that trip. But I leave at 9 in the morning, I'm back at 4 in the afternoon. It's been usual kind of work day. I can't count that meal. Now, if because wait. Let's back that up. Let's back that up some. Let's say that I go to 2 hospitals that are, one's in Montgomery, one's say in Prattville, and one's in Montgomery and here and there. I can't count that meal, but it is local and it's today. And typically, even the first one that I mentioned, I typically would not count that meal. However, your church may reimburse that meal. If it, and I'll show you in a minute why. I could have a meal for some other reason. Like, say I went to the hospital and there's a family there and they've been waiting all day and their loved one's in surgery. And I say, let's go down to the cafeteria and let me buy you lunch because you've been here all day. And you could do that. And that meal could be reimbursed because of hospitality. Then there's travel, the other column over here. Travel is out of town overnight. So I'm going to count my mileage, I'm going to count the lodging, and I'm also going to count meals on that overnight trip. That's travel. But we as churches, we get mixed up on what meals can we count. So first of all, staff meeting is not time that you would pay for the staff to have a meal, or you take them out to have a meal. The IRS looks at it as you got to have staff meeting and you got to have lunch anyway. So you could have done the staff meeting at church, and done that. So generally we can't count that. However, you can do a meal occasionally to celebrate birthdays and anniversaries and work accomplishments and stuff like that. And like here at the State Board of Missions, we do that. We do that occasionally. So that's something you can do. And these things come under what's called de minimis, and I'll show you how you can count some meals that maybe you're not thinking about. De minimis means that it's so small, don't worry about it. And I always get the question, is there anything we can do that's not taxable? And yes, we can, but it's tangible things. So here's a list from IRS Publication 15B. And so coffee and donuts and Cokes occasionally in the office, occasional use of the copy machine for a personal purpose, ham or turkey at holiday time, group insurance for spouse and dependents of $2,000 and $2,000. Beyond that, it has the taxable amount. Occasional tickets to an entertainment or sporting event, occasional party or picnic for the staff, coffee, donuts, soft drinks in the office sometimes. And then this is actually where your cell phone reimbursement comes, because we're not accounting for that cell phone anymore. We don't have to account for, we used to have to account for every minute. You showed how many minutes were business, how many minutes were personal. But we don't have to do that anymore. So the cell phone reimbursement comes under de minimis, meaning so small, don't worry about it. Now, just out of curiosity, I've always wondered, what do they mean by sporting event tickets? We have a little sporting event coming up this weekend. Do you think that's what the IRS is talking about? Probably not. Probably not. What do you think those tickets cost these days? Anybody heard?
Super Bowl?
Yeah.
I would think they're up to $12,000 to $16,000 a seat.
Yeah, I bet they are. Probably the cheap seats may be less than that, but yeah, you're right. So that's not what the IRS is talking about. The IRS is basically talking about like a local sporting event, or baseball is pretty cheap to go to, especially minor league baseball, or your local high school football game, or things of that nature. And then movie, I think they're thinking movie tickets or local theater, things of that nature. They're not thinking about a big expense, but those would not be listed as income. And then in that same vein, the IRS says that cash and cash equivalents are never too small to be accounted for. So even cash equivalent would be like a gift card. And so we really shouldn't give gift cards to the staff, because those are taxable, and how do you account for the taxes for it that you didn't run it through payroll? And if we gave a $100 gift card to our staff, well, you've at least got to deal with the FICA. How are you going to do that? So we shouldn't really be doing that. Okay, for hospitality, we can do a meal if there's a business reason to do it. And so for a prospect, that'd be one reason. For some hospital visit and they've been there all day and they haven't had lunch, and you want to take them and pray for them and stuff like that. For, let's say you want to meet with the chairman of deacons and take him to lunch to plan out the year. Now, if the chairman of deacons is your best friend and you like to go fishing and go out to eat with him, not those meals, but when you actually do the planning. And so for hospitality, you can do some meals, and those meals would be reimbursed. You can do continuing education, and we want to do this right, because there's some penalties that are potential involved here. If we had a non-accountable plan, if we didn't do it right, and I remember when my first church, They gave me, well, really, I had the whole package approach, and I carved out some money for business expense, but I didn't have to account to the church for it. So they gave that to me as, quote, tax-free. Well, that was wrong. And so there are some potential penalties. If it's a lot of money, then it could be a big potential penalty of even 225% of what occurred. Could be a potential penalty. All right, we're going to take a break, and then we're going to come back and we're going to take out the form on housing that's in your packet. Let's take about a 5-minute break, and then we'll start back, get some more refreshments at the back, and the restrooms are over here, and we'll take a 5-minute break. Both salary and housing are taxable for SE tax. Club dues are taxable. This would be like they give you a membership to some, workout club or Y or there's a, I wonder if it's still here. In Montgomery, there's a club that's basically a social club. It's just a real nice place to eat. And I've had a couple of friends who invited me to go there. Can't even remember what it's called now. Have you ever been, Beth? Y'all haven't been here a long time. Maybe you'll find somebody who's a member there. Yeah, but that's a club, So if they give you membership to the country club, that's taxable income. If they give you professional organization dues, that's not taxable because that's a professional organization that you belong to because of your work. Reimbursements. We've talked about the accountable versus non-accountable reimbursements. If they don't do it correctly, it's taxable. And if they do it correctly as an accountable reimbursement, then those business expenses come to you tax-free. It's just a reimbursement, no tax. And then cell phone, they can reimburse you for your cell phone use tax-free. They don't have to do the how much is personal and how much is business anymore. It's just something they can reimburse to you. When I can remember before we ever got a cell phone, I can remember a friend of mine that was in business, and it was just so funny. He was so funny. He said I just bought. He was the first one that I knew to have a cell phone. And remember they were in your car and in your trunk, and they're big and all that stuff. And he said, I just bought a $3,000 phone and I put it in a $1,000 car, So, but they were real expensive, and that's why we had to account for every minute. And the minutes were 25 cents a minute back then. But now that it is so cheap and a basic flat fee, I've been able to get my cell phone coverage for $25 a month, including everything, data, talk, text, and data. So they've just gotten so cheap that you don't have to worry about it, and you can be reimbursed for that. They can do continuing education, but if you've got somebody that's getting their bachelor's degree, we had a youth minister who didn't have his bachelor's degree, and we helped provide money for him to do it, and that money is taxable for a bachelor's degree. You can do an education assistance program, but that has to be available to anybody on staff full-time on an equal basis. And we weren't doing that. We were just providing it for one person. And so that one had to be taxable. Moving expenses are taxable. Benefits, we've talked about benefits, health care, contributions to your retirement, things like that can be done tax-free. And so the retirement contributions can be totally tax-free coming from the church. Those don't even go on your W-2. If you do the Roth version, then you are going to pay the taxes on it now, if you do the Roth version of retirement. They can also provide for you group term life insurance, disability insurance, and so forth. and then retirement. They can do other employee benefits, like I've known of a church that had so many young workers, they provided a child care assistance program, and they can do that tax-free. It's got to be a written plan. It's limited to, I think, $5,500 or somewhere in there as far as what it's limited to. They can do an adoption assistance plan. And I knew a church that was so committed to adoption that they did that for their employees. And you're not going to have, a lot of employees choosing to do it, but they could do that. All right. What questions do you have about what is taxable? What's taxable? You're going to see your tax person soon. You feel okay about it?
I do.
Good deal. I find that ministers, in my experience, are either using tax software or they're going to an accountant. And so I don't do the forms and things like I used to in this conference. We used to go over all the forms as if you were going to do it yourself by hand. But now we just talk about how can we save? How can we save on our taxes? How can we do a better job and better stewardship? And that's what we're trying to do. So it's also, tax time is a good time for us to look at our other total financial picture, total stewardship picture, total kind of life picture. So the questions are, how are we saving for retirement? Are we saving 10 to 15% towards our retirement? And all of us should be. If I was going to do it all over again, and I'm 73, about to be 73, if I was going to do it all over again, I would have bought a whole lot more stuff secondhand in order to put more money into my retirement. I'm pleased with what I've got in retirement. I'm thankful for people who led me to make those contributions and prompted me and prodded me to make those contributions. But I would have done it a little earlier if I had realized, just how important. So retirement savings, and make your retirement savings on a percentage basis, like, saving 10%, saving 15% of your income. So that way, if you get a raise, don't make it on a dollar figure, make it a percentage. So that way, if you get a raise, then it goes up with your salary. Group term life insurance, do you have enough life insurance? If you have dependents, then you might want somewhere between 8 and 12 times your income in life insurance. And your group that the church might provide is probably not going to be that much. So perhaps the church provides 2 times your income or 4 times your income in life insurance, and then you need an additional amount that you'd purchase yourself. Disability insurance. Do you have disability insurance? I've known of a number of ministers who became disabled, and oftentimes early 60s, like 62. And now I've got a dilemma. I'm disabled. I need to, the church has been carrying me all along here, but I'm not going to let them carry me anymore. I've got to quit. I'm disabled now. And now I've got a dilemma. Do I want to apply for Social Security disability, and I'm gonna wait a while, maybe a year or two, and I get more money that way, but I might have to wait a year or two, or do I want to just go ahead and take my Social Security benefit reduced at age 62? So you're kind of in a dilemma that way. But if you provided disability insurance, that can be very, very helpful. And disability insurance is not that expensive. The most expensive insurance is our health insurance. But so group term life insurance, disability insurance, those are relatively not as expensive. And then very, very, very important question today, do you have a will? I heard this recently, and I thought it's true. Everybody over 18 needs a will. and we all do. It's amazing what happens without a will, and the decisions the state makes for you that might not be the decisions that you would have made. So everybody needs a will. And Lynette and I, Lynette and I were going on a trip where, this was when our kids were younger, and we were going on a trip where we were going to be gone from them, and my parents were keeping their grandchildren, and we were going to be separated and on an airplane and that sort of thing. And just the thought of that made us make a will. So that was the first time that we ever made a will. But everybody needs it, even if you're not getting on an airplane or getting on a cruise ship. You need a will. Any other questions that you have about taxes? So you see that the increased standard deduction is going to help you this year. Your taxes will be a little bit better than last year. The brackets have crept up a little bit, which is going to help you a little bit on your taxes this year. Like I said earlier, you're not going to cut your taxes in half this year. The OBBB didn't do that, but it gave you some tax savings. And then there are other tax savings that we can look at and try to help ourselves to have a better tax situation as a part of our stewardship. Now, look for tax-free money. And so make sure that that you have a housing allowance, which is tax-free for federal. Make sure that you have an adequate accountable reimbursement plan. That is coming to you totally tax-free. Make sure your church is reimbursing you for your cell phone. Those kinds of things that are great tax savings. All right. If there's no other questions, we're going to wind it up. Everybody okay? I'm going to hang around for a few minutes. If you've got any questions, I'll be glad to deal with any questions for the next few minutes. But let's have prayer, and then we'll be dismissed. Father, thank you for this morning, and thank you for each person who is participating in this workshop. We just help you. We just pray that you'll help us to be better stewards, that we would be better stewards of what all you've given to us. And thank you for it. Thank you for how we've been blessed. Thank you for the way that you've provided for us. In Jesus' name, amen. Thank y'all so much.
Thank you.